Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today we'll talk with my friend and Stansberry colleague and fellow musician, Brett Eversole. In the mailbag today, a light mailbag with just one question from one of our greatest, long-time, most frequent correspondents. And remember, you can call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my opening rant this week, coffee shops and lipstick. That and more right now on the Stansberry Investor Hour. Coffee shops and lipstick. What in the world could I be talking about? Well, the coffee shop thing relates to an article I read in the Wall Street Journal this morning that said basically restaurants did well in June, but they still lost 3% of their sales, so not great. But coffee shops comparatively did great because their sales increased by 1.9%. So it reminds me of something that I may have mentioned on the program before. Real quick, I worked for a place called Lee's Ice Cream Factory based in Baltimore when I was in college and right after college. And Lee Garfield, for whom the business was named, he was a very smart businessman. He was the person who was he was basically the first guy who ever taught me anything about business, because before that I was a guitar player, didn't know anything about business. And one of the reasons he said he went into the ice cream business is that he had very fond memories of a place called Gwynn Oak Park in Baltimore as a child, and getting ice cream and going on rides and things. But as a businessman, he said, Dan, when people can't afford a vacation or something expensive or expensive Christmas presents or whatever it is, they will still take the family out for a treat. And, they'll take the family out to get an ice cream cone. It's one of the things they'll do. So that's one of the reasons why I thought it would be a great business, because if the economy wasn't doing great, he knew his business would still be okay. And he turned out to be right. Because I worked there year round and I saw that effect. I mean, even in the winter, like in Baltimore, people were coming in to get, a lot of people came to get coffee, but they also came to get ice cream cones. I mean, it's just like insane. But, we did well enough during the winter and we thrived the rest of the time, and it worked. Now, there's a similar thing with what is called the lipstick index or the lipstick effect, whatever you want to call it. That was thought up by a guy named Leonard Lauder, who is Estee Lauder's son. And he just noticed that lipstick sales did okay during a recession. He actually said they did better, but they did okay, right? They kept up. So it's the same type of a thing. It's like a little affordable luxury. Now, I contend that, during inflation, if wages keep up, if wages even approach keeping up with the rest of inflation, the lipstick folks will do okay, and the ice cream folks and the coffee shops and everybody, they'll do okay. But I think if we really get into a serious recession, and some folks analyzed Leonard Lauder's lipstick index, and during a recession, like if it gets bad enough, look, they stop buying everything. They stop buying water. I mean, water consumption goes down during a bad enough recession. Okay, so there's very few, if any, I can't name one in truly recession resistant business. So I think what we have right now is this conflict of forces, the forces of inflation and the forces of recession. And we'll see how it turns out. But at this point, I think we've seen the inflation, and I think we're going to wind up with stagflation. We're still going to have the elevated prices for, gasoline and food and rent and everything else. Your rent's not going down, right? And you're not going to spend less at the grocery store, and it's not going to cost you, less to do those basic things that you need to do just to get by every day. But on the other hand, I think we'll continue with this real decline, or real sort of suppressed economic activity. And that's why we're in a recession right now, because GDP is growing nominally a few percent, but inflation is so bad that it's pushing that down into the negative. So when they say the definition of a recession is 2 consecutive quarters of declining real GDP, that means real means adjusted for inflation, right? So right now, we're in a recession because we've had that. And what I'm looking at is, we could stay just in the area of a recession, right? We could say just under real GDP growth and be just in a slight decline. And it could be a really inflationary environment, right? So we get those effects more than we get recession. Or we could go the other way and we could get such a level of depressed economic activity that people stop going to the coffee shop, they stop buying lipstick, they use less water, and we're in a real recession. Maybe the Fed pushes interest rates up so high that we really depress economic activity. And right now, that's kind of the way I'm leaning, because one of the biggest sort of leading indicators is the housing market. And, we know like the housing related stocks have come down from their peaks and housing prices have come down from their peaks. Lumber prices are kind of pointing towards recessionary dynamics there. So we'll see. And that's real wealth, right? The equity in people's homes is one of the big sources of real wealth. So when it's going up and when it's large, and right now home equity is at a record level, around 27, or I think it's 28 trillion actually. So if we see a decline in that, that's a decline in real wealth, because people tap into that and they spend it. So we'll see. We'll see how all this plays out. I think the ultimate prescription is still the same. One last thing I wanted to mention was this Gallup poll that they had this thing called the Life Evaluation Index or something. And yeah, that's what it's called, Life Evaluation Index. And Gallup put out a poll where they said, they interview people and they say, are you thriving? Are you struggling? Or are you suffering? And 5.6% of the respondents said they're suffering. Doesn't sound like a lot, but it's a record high in the data going back to 2008. So it includes everything that's happened since then: COVID, financial crisis, everything. And people are suffering more at this moment. I think they're probably suffering because of this combination of inflation and recession, right? Stagflation. So with that in mind, it's hard to be an investor. I still think being truly diversified is the answer. The true diversifier is cash. So you own plenty of cash, own some gold and silver, maybe Bitcoin. I'm not doing it right now, but maybe that. And equities in really great businesses that produce high returns on the money they reinvest in their business. And it should be a business that makes enough to reinvest plenty at high returns in itself, right? So if you can do that, hold on to your great stocks, have plenty of cash, have some gold and silver, maybe some Bitcoin, I think you're basically truly diversified. I mean, real estate is nice and land is nice, but if we get that recession, it's a highly illiquid asset, and if you want to get rid of it, it's going to be worth a lot less. So, yeah, but if inflation is the sort of dominant force over the next few years, then you will want to own that real estate because it'll rise in value. So it's difficult, but true diversification is all I got. It's all I can think of. And so far, it's not working out too bad, I have to say. All right, that's where we are. It's a tough moment. I want to leave you on a pleasant thought, but I don't think it's the right thing to do. It's a very difficult moment to be an investor because of the competing forces of inflation and recession. That's where I'll leave you. And with that, let's talk with my friend and colleague, Brett Eversole. Let's do it right now. One of the most successful entrepreneurs in America over the past 50 years is going public with his fourth and final prediction about a scenario he calls America's nightmare winter. Woo! You've probably never heard of Bill Bonner, but in addition to owning an interest in businesses all over the globe, he also owns more than 100,000 acres with massive properties in South America, Central America, and the US, plus 3 large properties in Europe. And I've been to one of them. It's gorgeous, gorgeous chateau. And I've known Bill for many, many years. He hired me into this business. And he says we're about to enter a very strange period in America, which could result in the most difficult times we've seen in many, many years. And he's made 3 similar predictions in his 50-plus year career. And each time it proved to be exactly right, although he was mocked each and every time. And I remember all of them. This is why I strongly encourage you to read about Bonner's 4th and final prediction, totally free today. It's all spelled out in a free report that we've put together called America's Nightmare Winter. Get the facts yourself. Go to www.nightmarewinterscenario.com to get your free copy of this report. Even if he's only partially right, it'll dramatically affect you and your money. So again, go to www.nightmarewinterscenario for this free report. Today's guest is Brett Eversole. Brett Eversole joined Stansberry Research in 2010. He worked alongside Steve Sjuggerud to develop True Wealth Systems, and he now works with Steve on True Wealth Systems, True Wealth Opportunities China, and True Wealth Opportunities Commodities. Sounds like a busy guy. Brett's background is in applied mathematics and statistics. His undergraduate degree is in actuarial science. As an undergrad, he passed the first 3 exams for entrance into the Society of Actuaries before focusing on finance at Stansberry Research. His analytical and data knowledge make him the perfect complement to Steve Sjuggerud's financial prowess. He used those skills to help develop True Wealth Systems, one of Stansberry Research's most in-depth data-driven products. And with that, Brett, welcome to the show.
Thanks for having me, Dan. I'm excited to be here and chat with you. You know, you and I don't get to catch up that often, maybe once or twice a year, but I always enjoy talking with you because you've always got something that's really grinding your gears at the time. So I always leave those conversations enlightened and entertained. So glad to be here.
Well, you know, as long as I entertain you, Brett, I'm fulfilled in life. I really am. But we're here to talk with you today. Believe me, the listeners have heard sufficient from me. You know, I promise. Yeah. But you know, I was looking through the archives of investorhour.com. I could have sworn you'd been on the show once before, but I couldn't find your name anywhere. You have not.
No, I haven't. Nope.
Well, okay. Well, that's an oversight, and I'm glad we're taking care of it. So before we get into what's on your mind, you and I had talked about housing before we hit the record button here, and I definitely want to get your views on that. It's a very interesting topic to me and to the listeners right now. But just real quick before we do that, you know, give me the 30-second background on Brett. Like, how did you get here?
Well, so I got a degree in actuarial science, which is kind of like applied mathematics. And while I was going to school, I met a guy named Tom Dyson, and I'm sure you know that name, and longtime Stansberry folks might know that name. And Tom was working down in Florida. I grew up in Indiana and went to school there. Tom was working down in Florida. I got to know him through kind of a friend of a friend, and he actually taught me to surf one summer, summer of 2009. I graduated the next year, and he gave me a call. I hadn't talked to him in 6 or 8 months. He's like, I don't know what you're doing after school, but I've got a job for you if you want to come down. And I took a chance. And the funny thing is that job he hired me to do within about 6 weeks had completely dissolved and dissipated. And so I was kind of assuming I would just move back to Indiana and figure things out. But alongside Tom in the office here was Steve Sjuggerud. So Steve had been meaning to hire a guy with a math background for years, and I kind of landed in his plate. So kind of the rest is history. I've been here for 12 years since then. So
yeah. So working for Steve Sjuggerud on True Wealth, and there's a whole bunch of publications you guys do. Can you list them real quick?
Yeah. Right now we have True Wealth Systems, and True Wealth Real Estate. We have in the past we've had a commodities letter and a China letter, and we've since folded those, but those 3 at the moment.
Right. So that's really cool. That thing where your job kind of dissolves before your very eyes, that's a common occurrence in the newsletter business. But we do hang on to good people, I will say that. I've seen us do this many times over the years. I'm glad we hung on to you.
Good people and the 2 of us, right?
Yeah, good people plus you and me, yeah.
Yeah, there you go.
But one more thing before we get to housing, which I really do want to talk to you about. So just for our listeners' sake, since we have established that you've never been on the show before, If you and I just met in a bar, you didn't know me, I don't know you, and then we got to talking about finance and stuff, and I said, "What kind of investor are you?" How would you answer?
So I am very much a top-down investor. I'd say I take the opposite view of Dan Ferris. I like to think about all of the macro kind of big long-term tailwinds at a very high level, and then figure out how they're going to affect sectors as opposed to overall markets, and then find individual companies out of that. So very much a top-down type of analyst.
Right. I have a secret, desire to be able to do that, but I've proved kind of bad at it so far. I mean, I can make the calls sometimes, but what to do about it, I'm kind of bad at that. But you're pretty good at it. You and Steve and the whole crew down there.
Well, I think one of the importance with that style is you have to be maybe more willing to be wrong more quickly.
Mm, yeah.
When you're doing the kind of research you do, and you're taking a very long-term view and doing like hyper detailed company analysis, I would say you probably have more skin in the game and understand things better than I do. But what we're good at is finding these big macro tailwinds, and we assume it's going to go a certain way. And if it doesn't, then we'll just cut the cord and move on, because there's always kind of these big themes going around various places in the world. So I think the a willingness to kind of cut and run quickly is a way to do that right.
Right. So I have to tell you, Brett, I mean, you're a bright guy. You've been around a long time in this business, but that sounds so much like Steve to me, what you just said.
Well,
It's, I mean, that's like the Steve Sjuggerud way, isn't it? I mean,
yeah,
see which
yeah.
way the winds are blowing, go that way. And if the wind direction changes, you're out.
Yep.
It's just,
Well, I mean, Steve mentored me for a decade here, and when I showed up, I knew numbers. I had a math degree, but I took one finance course, I think, in college. Didn't even learn. I learned nothing. Let's be honest. I knew nothing about finance, and I understood numbers. So I
right.
definitely become a clone of Steve over the years, which is you could do worse.
You could do a lot worse. Yeah, as a matter of fact, you can almost hardly do any better, if we're being really honest. So let's talk about, if there's more than one sort of sector that you want to talk about, by all means. But you and I did exchange a few words about housing, and right now I know some folks are very concerned because they see, they certainly see lumber getting killed, and then they see housing prices starting to come down. In the like the indices, like the Case Shiller and stuff, or I want to say like I saw a report, Mortgage Bankers Association. They had reported, purchase prices of actual deals coming down 10 or so percent, and then national housing prices had come down too by the indexes. So, but where are you on all this? I mean, that I just painted a really, little picture there out of a few data points that may or may not be worth anything, that kind of sounds bearish. Where
Yeah.
are you on housing?
So I think a lot of times people end up, kind of fighting the last war, and I think that's what's happening in the housing market right now. The last war being the 2000s bubble and bust. And it's easy to look at what's happened, especially in the last 18 to 24 months, kind of in the pandemic era of, there's a lot of pretty obvious froth that was in the housing market. Um, but I think the setup that's really happening is that we have a situation where the perception is that we've got a bubble that must lead to a bust, and the reality of the situation is something quite different. What I found is you make the most of money in the markets when you can or you can find an opportunity where perception and reality don't meet, and there's a way to take advantage of that. And I really think that's where we are, kind of in housing right now. Um, so, like to the point you said, like there's definitely a cool down that's happening, and we definitely have come out of like a very bubble environment. I've got some crazy numbers. Earlier this year, we're in North Florida in Nassau County. Um, there was a time earlier this year where there were 1,100 real estate agents in the county and 180 homes for sale. So that's a 6-to-1 ratio of real estate agents to homes. And at that time, for the entire state of Florida, that ratio was 10-to-1. Um, so obviously, like that's not sustainable, and there was some craziness going on. I mean, I think in our area, I saw just dozens of people, mostly in their late 20s, early 30s, go getter types that just saw housing as just easy money, just free money. So everybody was trying to get into real estate and figure out how they could, start selling $400,000 houses in 24 hours and make that fat commission. And the market just got really flooded and got kind of crazy. So like we're definitely due for a slowdown, and we've seen activity slow. pretty dramatically. But I think the idea that we're due for a major bust like we saw last time, I think that's where perception and reality get a little off. And, we've already, like I said, that slowdown has happened, and it's mostly been it's been caused by mortgage rates. Mortgage rates went from like 3% to about 6% this year, which is a crazy increase. If you do the math on that, that makes a home or a typical payment about 40% higher. So even in the crazy 2 years we've had, home prices haven't risen 40%, but in 6 months of interest rates, the payment just went up that much. And affordability has just crashed as a result of that. The affordability index looks at home prices, mortgage rates, and incomes to figure out like kind of what the typical person can afford. A 100 on that index means that the median income can afford the median house. We were at 180 at the start of the year, or last year's high, and now we're at 100. So we've gone from housing being pretty darn affordable to not at all affordable. And obviously that's at a nationwide level. Certain markets are not affordable at all. But I think in a lot of times, bad things happen and people extrapolate them out into the future and they assume that what's bad will get worse. So you see a 6% mortgage rate and you assume, well, 7%'s next, and then 8, and then 9, and then 10. And while that's possible, it doesn't seem that likely to me. And I think the only way that kind of affordability can get a lot worse is if mortgage rates just continue to soar, which doesn't seem like a likely setup to me. The thing about this, though, is even if affordability is down, housing is like water. It's literally at the bottom of the Maslow's hierarchy of needs, right? You got food, water, shelter, clothing, shelter. So you can't just decide housing's too expensive and that you don't want to have a house.
Right. And for people who don't know, Brett, the Maslow hierarchy of needs, the bottom is the ones you can't live without, just so we're clear.
Yeah, exactly. Right. Exactly.
That's the foundation.
Yeah. So I think we have this setup where people are just kind of assuming the next bust is going to come. But the situation today is just very different than it was in 2006, 2007. Homeowners themselves are actually in like dramatically better shape from a financial standpoint. I know like tappable equity, like home equity, is at the highest level it's ever been. I think like subprime lending is at maybe 5 or 6% of loans, and in 2005 it was at 20 or 25%. So I think the market generally is just in a much healthier state than it was last time around. And to me, that's kind of an obvious reason why a slowdown doesn't necessarily mean that there's a major crash on the way. Obviously we've seen a slowdown in activity. Existing home sales are down like 20% from the high. But that's also from a pandemic-induced mania high. So if you actually look at that chart over like 30 years, today's level is pretty typical with what we saw on average over the last 30 years. Right. And when you look at a lot of these things where we're down a ton off of the high in activity, it's really just we're down a ton from a crazy level to a normal level. And if that falls another 30% from here, then that's not a good thing. But it's, again, bad things happen. Extrapolating them into the future gets a little dangerous, in my view, at least. And the thing
I think I tend to agree.
Go ahead.
I was going to say I tend to agree. It doesn't. You can get a reset. I mean, we can get a reset and a drop in price and all this stuff without some major crisis happening.
Yeah. I think that's important. Like nobody panic sells their house.
Right. They panic borrow against it maybe, but don't panic sell it. So with that in mind, I'm sorry, I did interrupt you. You sounded like you had another stat to throw at me or something.
Well, no, it's just like one more thing, like about this whole thing. We, as a nation, just face this massive housing shortage. There just aren't a lot of supply of homes. And that's a big reason why we had this manic market for the last 2 years. I think inventory of existing homes is like 50% lower than it was 10 years ago. And the month supply, which is like how many months it would take to sell all the homes for sale right now at current levels or current rates of sale, is at 3 months, it's typically more in like the 4 to 5 range. So we're chronically undersupplied with housing. Well, I mean, that's not a tight spread, but like very, very high would be like 6 or 7 months. So that's a relatively tight index. But we're just chronically undersupplied with houses. And that's because, coming out of the housing bust, we just didn't build houses nearly fast enough. I ran these numbers earlier this week, and what I looked at was millions of housing starts per year on average by decade. And basically for every decade except the 2000s, since the 1960s, we built about 1.5 million houses a year. And last decade, or the 2010s, we built 1 million houses. So over a decade, that's 5 million less homes typically. And also, what's the US population today versus in 1960? It's 50, 75% higher. So we had this massive just like housing shortfall. And if there's a lack of supply in a market and there's a lot of demand, how are prices going to crash by, in my, 30 or 40%? Jacksonville, where we're close to, crashed 40% in 2008. And to me, there's just such a large macro tailwind behind housing that doesn't really seem possible to me.
Okay. So what if, all the telegraph signal from the market is that we will see higher interest rates still by the end of the year? Do we think, first of all, let's just say we accept that, okay, for now. Let's
Sure.
just say that the Fed does go another 75 bips higher and, the spreads stay sort of constant, right? So, then we get back, around 6% plus, right, for mortgages. Um, the trip to 6% was brutal from 3, right? So,
Yeah.
but, just call it 6.5 or something, or even 7, whatever you want. Seems like it would be less brutal, but it's a much higher number than anybody's used to, that's for sure. How do you feel about the intersection of interest rates and housing in the next, I don't know, 6 or 12 months, whatever time frame you like as
Sure.
well?
Yeah. Well, I mean, I think your point, like in prevailing interest rates are, people talk about the CPI and Fed actions. I mean, I get the Fed kind of is it, but prevailing interest rates are kind of the only thing that matter, right? And not just what they are, but their trajectory, because we've saw this massive change in investor sentiment because money's not free anymore. And that's affecting the housing market, that's affecting the stock market, it's affecting everything. But I do think the way you get there is not as important, but certainly an important part. So a move from 3 to 6 in 6 months is really brutal, like you said. I think if we have a move from even 6 to 8 in 12 months, that's not fun, but people are able kind of like more easily reset expectations along the way. Just that quick move is really, really painful. And it forces people to immediately change their thinking. And also coming from a lower base is important as well, because when you move from 3 to 6, money's free at 3, but at 6, it's not free. And it's less free at 8, but the general psychology shift is less, I would say, if that makes sense.
Sure. No, I'm glad you brought up the psychology shift because we could just generally refer to it as the inflationary mindset, if you don't mind that. It is quite a bit different. I lived it once, but I was like ages 11 to 19 or so, so I didn't know anything, and it didn't sink in firsthand. But I've certainly looked back at it, and it was a very different mindset. But I noticed like it took years, like the inflation of the 70s actually began in the late 60s from the so-called guns and butter, right? There's always a crisis. Inflation, in my view, only comes from the government because they're the ones with their hands on the printing press, and it came from the guns and butter, right? We had to have guns for the war in Vietnam, and we had to have butter for the growing welfare state at that time. So we got some inflation and nobody was worried about it. And then all of a sudden 1971 came along and Nixon temporarily cut the cord with gold. And, then we got the supply shock in oil, and, that decade just got totally out of hand. But I do have memories of that mindset. I have memories, as certainly as a high school student in the mid late 70s, sitting in line to get gas on the even numbered days because our license plate was even numbered with my father in the morning before going to high school. And and people talked about the cost of everything all the time. Who I am and my career choice is based very largely on hearing the words during that decade, "We can't afford it." And it burned itself into me. And I tried to be an artist when I was in my 30s, and I was like, I can't afford anything. You know what I'm saying? So that mentality, I mean, the point is, that mentality can burrow in and affect a whole generation of people if you believe inflation is going to continue like anything like this. What do you think is going to happen?
Well, I mean, maybe I shouldn't admit this because I haven't actually written this anywhere, but I'll tell on myself.
Just say
If
it
you'd asked
quiet.
me, yeah, there you go. If you'd asked me 6 or 8 months ago, I probably would have been in the transitory team, um, just because this does seem like a relatively supply shock induced uh, panic for the most part. Although, and this is another kind of an aside, but I find it funny as this inflation talk kind of enters the kind of social zeitgeist. So you have all these people who talking about finance that don't really understand it, and everybody's mad at the Federal Reserve, which
I
is
know.
fine. Which is fine, but the Federal Reserve took
Sure.
interest rates to zero in 2008, and then printed $4 trillion in the interbank system, and we didn't have any inflation.
Right.
But then the government actually spends in fiscal policy $4 trillion, and then
Yep.
we get inflation, and people are mad at the Federal Reserve. And you don't
Yeah.
have to like the Federal Reserve, but do you
Y-
understand nothing about how this stuff
Yeah,
works?
exactly. I mean,
Um,
certainly, like, you can blame whatever you want on the Fed that's actually theirs, right? So you can say they
sure.
manipulate the bond market. You can say they've made money too easy. But the problem is, you're right. Like, they swap a dollar they print too. They do it. We know they do it. But they print that dollar and they swap it for treasuries, and it just sits in the Fed Reserve account, and the lending activity is not there. There's not a 10x multiplier effect on that money. The reason why I am saying that inflation is stickier than most people realize is not because of that. We're not going to get what Hugh Hendry, hedge fund manager Hugh Hendry, who we've had on the program a couple times, he calls inflation a social phenomenon for that reason, and he's referring to the animal spirits of bankers to lend, and that multiplying effect on those reserves that we don't have. I'm just talking about the stickiness of 4 or 5 trillion, however you want to measure it, in newly printed dollars that have been spent into existence by the federal government. And you don't you can print 4 or 5 trillion of dollars, but you can't print 4 or 5 trillion of goods and services like that, right? So at least a little stickier than, certainly not transitory, right? I mean, what if we get 3, 4% for another 5 years or something instead of two?
Yeah, you look at the 70s too, and that's kind of what happened, right? You had a big spike and then it settled down, but the settle down was at a much higher rate than what happened previously. And then you had another
Yeah.
shock to the system, and then you had a way spike up and then a settle down. But that settle down, that's the thing. If you get a settle down at 4 for 5 years, when the normal settle is 2, like that's a lot of residual increase that you above like the norm, right?
Hmm.
So it does seem like, I guess when I say transitory, yeah, I don't think we're going to see 2% inflation anytime soon. But if we're still getting prints at 8% plus 12 months from now, I'd be relatively surprised. I don't think it's out of the question whatsoever, but I would be surprised.
Yeah.
Um, we've had this. I want to ask you a question, Dan. We've had this kind of thought experiment in our office chatting about this. But say you and I are sitting here 50 years from now, and we're studying this period, and a year from now, inflation's at 3%. Would we study this and say that it was transitory after all?
Oh, 3%, that's something. If we
The
if
number
we
matters, I realize,
yeah, yeah, it does. So we settle at 3, um
but
we
it
have
took
to
two and
bel
a half years
it took
instead
two
of
and a half
one.
years, right, to settle at 3. So, we'd call it the 2022 to 23 inflation, or whatever, to 24, whatever it was. We'd call it a 2-year inflationary cycle, let's just say. Um, and we'd say, "Huh, oh, okay." And overall, though, overall, um, Your earlier point is well taken still, though, isn't it? Because um, we we serve ourselves poorly by extrapolating to a crisis, right? We serve ourselves poorly by saying, "Well, the housing market's going to do the same thing it did, you know, '06 to 2012, prices falling, that by the Case-Shiller indexes
Yeah.
falling all that time." Probably not, right? Probably not again, right? So, the 1970s, whoa, really on average throughout the decade, double digits, right? Inflation, whoa, gold from 35 to 850, the spike up to 850. Um, but hanging around in the several hundreds an ounce for a while, probably, maybe not again, right? We're not gonna cut the cord between gold and the dollar again, right? So the point is well taken about not extrapolating a trend to a crisis point. That said, I mean, who trusts these people? You know what I'm saying?
That's fair.
Like, does the Fed have your back? Do you really think the Fed has your back? I think that the Fed is in a mode where it used to be cool to ease, and now it's going to be cool. Now it's cool to tighten. The language to me seems to have changed. It's like, oh no, we need, Powell talks about neutral versus restrictive monetary policy, right? And I think he sees restrictive as proven that he's got the cojones to do this. You know what I'm saying?
Yeah.
But that's just that's just reading. There's nothing technical, or it's a purely anecdotal. Dan's opinion.
They'll just
We'll
fire
see.
him and hire somebody else.
Yeah, that's right. Right. If he tightens, he'll be out.
I mean, but to your point, one thing I noticed this year that I thought was interesting is how quickly, probably a more like investor class, people thought the Fed put is like dead forever. Like that became a narrative kind of like overnight, maybe February or March. Like, okay, we have
Mhm.
this really bad inflation. The Fed's not going to be able to ease and help the market like it has in the past. And the kind of assumption, again, extrapolating, is that like, okay, well, they're never going to do that again. And to me, that's kind of like a silly point, right? Like,
Mm.
inflation might take a much longer than a lot of people realize to kind of get under control, and they
Mhm.
might have to take the Fed funds rate a lot higher than anyone would prefer. But the idea that I mean, do you do you think we've seen 0% interest rates for the last time, Dan? I sure know I don't think that.
Yeah, I mean, yeah, I wouldn't say that at all. In fact, I know I probably wrote one or two things about this. I think I wrote a digest where I said the Fed was turning Japanese at one point in the past few years, because I thought, well, we're headed for zero and sub-zero interest rates here. We're headed the way of Japan and Europe. Um, Ultimately, not in this
Yeah,
instance, but the idea of running that playbook, the Fed has bought bonds. They bought all manner of bonds at this point, that you could expect them to buy. I mean, I don't expect them to buy, triple C or anything, but they bought all kinds of bonds, and it's just one more step to the next step in the Japan, Bank of Japan playbook to buy. I think the Bank of Japan actually bought ETFs, but they're equity ETFs, and
yeah.
they bought a ton of equity. You
They've like
know,
cornered the market. I think at one point they owned like 40 or 45% of the entire ETF
yeah,
market. Like
yeah,
it's crazy. Yeah.
yep, yeah. So I mean, they don't have a lot of tools, right? They're really, it's a man with a hammer. Everything looks like a
Yeah.
nail, and they've got one tool, really one small set of tools. And so you're right. I fully expect if my genetic material is as good as I think it is. My father, bless his soul, lived to be 96. So yeah, I don't know. Maybe I'll do a little better. Maybe I'll hit triple digits. In which case, I've got 40 years, and in the next 40 years, no chance of zero interest rates. Your point is exceedingly well taken on this guy.
Yeah.
Yes.
And I think to what we were saying before, like fiscal versus monetary policy,
Mhm.
I think Powell's smart enough not to say in public that inflation isn't his fault, but behind closed doors, he definitely thinks that's the case. I mean, I
Mhm.
don't think that they're looking at their actions and saying this is what caused this problem. And if they do have that mindset, then the second they can ease, they're going to, right? Because they don't
Yeah.
see any long-term consequence of that. whether that's
Right.
right or not. That's going to be their view.
Right. So you mentioned the narrative around we'll never see the Fed put again.
Mm-hmm.
I have to say, I have picked up a narrative the opposite. I have picked up the Fed pivot narrative. Like at one point, I went to Google Trends for Fed pivot, and it was like 100. I mean, Fed pivot was on everyone's lips, and I'm on Twitter like way more than a normal human being should. So I saw it there a lot too. And my feed, your Twitter feed is self-selected, and it still came through, right? So, I mean, what do you think of that idea? What do you think of the idea that, they put on another 75 bips or so by the end of the year and they're done, and then essentially pivot?
I don't see how that's possible at all. I mean, the market's definitely pricing that in, right? Like the yield curve
Yeah.
is massively inverted right now. But that
Mm,
seems like not possible whatsoever. Like you talked about the 70s inflation, that didn't get under control until the Fed funds rate was higher than the inflation rate.
mm,
And so even if we are going to see some deceleration like we saw this month, like there's no guarantee that happens going forward, but even if we see major deceleration, like there's a lot of hiking to do to get above 5, 6 by the end of next year, like
mm,
above that level.
right.
So the idea that we're near like the terminal level
Yeah.
seems insane to me. I just don't see how that's possible.
You sound like Druck almost. He thinks that historical precedent might not hold this time. He thinks we might not have to see that.
Well, again, like what Powell says in public versus behind closed doors, I bet, and they've kind of done this in their language in the last few meetings. They haven't said the word transitory, but they're kind of say like the market's taking care of this for us,
Mm,
right? Like they've
right.
kind of said those kind of things. So my guess is they're hoping that they can do a few more hikes and we're going to see deceleration because the supply shock problem begins to solve itself. That many trillions of dollars the US printed kind of filters out
Hmm.
and the inflation rate comes down on its own and let the market do the work for them. That's if I'm them, that's what I'd be hoping, right? Because I don't want to have to be the guy that everybody hated Volcker. We only love him now. Like that was I wasn't alive
Yeah.
then, but reading the history, that was not a fun time to be
Yeah.
in the financial markets. He was not a popular guy at the time. So I don't think Powell wants to do
No.
that if he doesn't have to.
Yeah. I, for one, will never lionize that guy. I'll never lionize it. That act of just, pushing inflation way, way into double digit territory, or I'm sorry, pushing interest rates way into double digit territory. I think it hurt a lot of people. And I think again, the effects of that, I think, were felt for years and years, of both sides of that, the inflation that preceded it and the brutal recession that followed. So I don't know. I think the problem is that these folks think that they can tweak and manage and control a $24 trillion economy from the top down, and they can't. And they never say, something, we can't do this. The problem is us. They never say the problem is us. The problem is always, oh well, we need to tweak more. We need to tweak different. We need to tweak another way. We need to spend more. We don't need to spend less. So I don't know. That's what keeps me in, if you must call it this, extrapolation to crisis mode. I'm always on the lookout for, I don't know, I suppose you could call it a tail event or just something really bad happening that nobody anticipated.
What do you think that event is today, if you have any thoughts? Because I think we're in that position, like generally speaking, with the market in general,
Yeah. So
where
go
bad
ahead.
stuff is probably going to happen. We might get a recession, but unless we need a Lehman type event for this to really get brutally ugly, in my view. And I just don't know what that is. So I'm curious what your thought is.
Yeah, my problem is I can't claim to know what it is, but I think because it's not, it'd be a knock-on effect. It would be a second, third order effect of something happening, and I can maybe guess about the something, but not the second or third order effect. So the something might be a reverse wealth effect, right? We households generally have two big sources of wealth. They've got their 401k and they've got their house, and that equity, which has reached, I think it's 28 trillion now, record heights. That's real wealth. People pull that out. They pulled it out, before the big crisis started, in 2008, and they tend to pull that out and use it, and it's real. So if it goes away, that's a real source of wealth that evaporates. And here we've taken now we could just call it maybe a 15 or 20%, whatever index you want to use, hit to one side of that. And if we see a big hit to the other side of it, then we could get deep into recession territory. And once we're there, you tell me, contagion in the bond market. I don't know. I don't know what the second or third order big scary event that I'm really scared of is. That's maybe is one way into it. I don't know.
Well, let's just keep our fingers crossed that I'm right about housing then.
That's right.
It'll all
Fingers
be fine.
crossed. That's right. So that's right. That's what you've learned here today, ladies and gentlemen. Brett is allaying your fears. Dan is
That's it.
way too afraid, and Brett has saved the day.
It's good to have optimists and it's good to have pessimists, right? Not that you're a pessimist necessarily, but you lean that
Right.
direction.
Well, yeah, I mean, I have leaned in that direction lately. I just have this view that, you should be a bottom-up investor most of the time, and, it's what feels right to me. But there are times when the top-down gets so extreme. I think at the extremes, one needs to respect cycles, and cycles do occur, right?
Yeah,
And cycles are brutal, aren't they? Cycles don't care about how wonderful your business is, do they?
not a
Right?
bit.
Like Dan spends all this time looking at free cash flow and balance sheets and moats and all this crap. Cycles don't care about any of that when they really get cooking at the extremes, right?
Yeah.
I guess, yeah. So if you subscribe to my newsletter, maybe you should get Brett's too, because he's more in tune with the cycles than I am.
There you go.
Yeah.
So,
All
Dan, I got
right.
a question for you as well, maybe off the topic of finance.
Okay.
But I know you're a great guitar player and musician. What's got you interested in the music world right now? Are you playing a lot of guitar? What's your rig look like? Tell me something, if anything.
Oh,
I know you were playing a Parker for a while.
yeah, I do still have my Parker electric guitar. I haven't performed with it in public. Actually, I haven't performed with that guitar in public for ever, ever.
Okay.
And I haven't played electric guitar in public probably for 15 years. And last time I played classical guitar in public was a few years ago at the Stansberry conference, before pre-COVID, right?
Yeah.
And I decided at that point that I don't play noisy rooms anymore, so I probably won't be back there doing that. But, I'm getting old, Brett, so I have little aches and pains in my hands, and, I am still learning, and in some ways, my technique is better than it's ever been.
Okay.
Um, but I don't practice a whole lot, and my repertoire has kind of shrunk because of that. But like I say, on the other hand, like, I'm playing some of the great virtuoso pieces that I've always wanted to play. I'm just not playing like 40 of them. You know what I'm
Okay.
saying? I'm playing like 5 or 10 of them. So
That's
what do
fun
you
though.
Yeah, you are a musician yourself.
Yeah.
What are you up to these days?
Yeah. Yeah. I play guitar as well. I play electric at the church we go to. So I do
Hmm.
that a few times a month, which is fun. And, I grew up addicted to like progressive rock and metal. So I'm always trying to learn things that are way outside of my skill level, but it's a fun challenge.
It is, and I've always done that too. I mean, I was like first year university guitar student, a classical guitar student trying to play J.S. Bach lute suites, the most complicated stuff on the guitar. And it took me years, but I'm finally doing some of it. So,
Yeah.
but I have found that there is an intersection between music and finance, if only in the fact that you had better be constantly learning, or you're going to stagnate badly, and you're going to fall way out of step really, really quickly.
Yeah, I agree. It seems like it stimulates your brain in a similar way. I don't know how to describe it other than that, but my brain, when I'm learning something finance related, I'm never more engaged mentally than when I like feel like I'm uncovering stones that have never been uncovered. Of course they have, but I'm learning them for the first time. And I get the same thing with music when I learn new things and pick up new techniques, and it very much stimulates my brain the same way.
Yeah, yeah. And for me, those the learning has definitely informed my investing. And you're right, it is hard to articulate it, but I'll give it a crack. I read a book called How We Learn by a guy named Benedict Carey, and it was talking about how you can learn so much simply by being consistent and by being on a decent schedule. Like you could learn something brand new on a Monday, you reinforce it on a Tuesday, and the way your brain works, you could wait a week to come back to it. And when you reinforce it after that week, that's as hard as your brain can work at it, basically. You don't Yeah, in other words, I spent years, 10 hours, 12 hours in a practice room doing the same thing day after day after day to try to beat it into myself. And I read that book a few years ago, and that's when I with less practice time than ever in my life, I have picked up a lot of things, and that's filtered into writing for me because now I'm much more inclined to do the research and, start putting the reports together earlier and more often, but not pulling all-nighters anymore. I don't have to stay up until midnight, the night before a deadline or the night before a report is due or something. I can just The act of going away and coming back is really valuable. Like, I value that cutoff. I get up at like 5 a.m., so my cutoff is 4 p.m. Usually, and I'm by 4 or at the most 5 p.m. I'm like, that's it. I'm done. I'm away from this, because the stepping away and being away and then coming back is super duper valuable. It's like weightlifting for your mind. It really is, because what I've learned about weightlifting is you just get the weight that you can control. You don't want to overdo the weight, but it's just slow reps to muscle failure, to momentary muscle failure, MMF. And you do those slow reps. And that's how I built, like, I wasn't doing anything and I was trying to move all this weight around. I wasn't getting anywhere. But then I just did the right schedule, the minimum weight that I needed, to really get some resistance that I could control and do those reps. And there's an intersection in all of this for me. I'm probably not articulating it great, but there's an intersection here that's something like, you know, be consistent, don't overdo it, do everything often and early and in the right way with the right rhythm. Not like when I was young, and you're younger than me, so you probably remember, you may still be in this part of your life where you're just like intensely going at everything all day long. Can't do it. And it turns out I don't need to, that's not the way it works.
I found a similar process to what you described when I write as well. When I first started, or for years after I started, I would kind of write as I researched and try to like intermingle the two. Those are very much like doing research and writing are very much two different disciplines. And I would try to intermingle the two. And what I would end up with is it would take a lot longer than it should, and the end product wasn't nearly as good. And now I basically make sure I do all of my research, get everything organized together, and then I'll write kind of like a half a dozen bullets, and I'll figure out how I want to organize those bullets mentally. And then I can come in the next day with everything in front of me and I can write 5 or 6 pages in a couple of hours. But it's that, and the product is much better. And it's, to me, it's that organizing, like you say, like when you're doing the research, do that task, and I'll do it over 3 or 4 days. Get everything together. I'll come in overnight. I'll wake up in the morning and take a shower and think about something that I missed, and then go and put all those pieces together, organize all those pieces, and then you can execute the writing really easily. But I do think you're definitely onto something. Like, don't try too hard. Trying too hard is generally not a good thing. And finance
Yeah.
generally is a weird thing where learning more and trying harder doesn't make you a better investor. Oftentimes, it makes you a worse investor, which is
Yeah.
very. It's a weird thing in life that's like that, but it's very much like that.
Yeah. Jeremy Grantham of GMO, who has made a thorough study of 30 odd bubbles and did great in 2008 and during the dot-com era. He has a quote that I could probably Google it, but I don't need to because I can get the gist of it. The gist of it is hard work gets in the way of thinking, right? Hard work gets in the way of thinking. That plays right into what we're saying. And I think this is actually a good place to ask you my final question. We're on a good track here. So the final question is the same for every guest, no matter what the topic, even if it's not finance. And it is very simply, if you could leave our listener with one thought today, what would it be?
I guess don't try too hard.
That's not bad. That is not bad. As
That's
final
something
thoughts,
that everyone can take away.
yeah, right. Work consistently. Don't try too hard. Yeah. I mean, there's context, but just having that, on a plaque on your desk is all the reminder that you would need for the entire context. I agree. Don't try too hard. It's a big mistake.
Yeah,
Well,
I
thank
agree.
you for that. Thank you for that. And thanks for being here too, Brett. It was good just to talk to you again. It's been way too long.
Yeah, you as well, Dan. Thanks for having me. I appreciate it very much. And yeah, it was a lot of fun catching up.
Yep. All right. Well, I guess that's bye-bye for now then. Once again, I have to say, I hope you enjoyed that as much as I did. But I realize what I really mean by that is I hope that was as insightful and fulfilling a conversation for you as it was for me. And I think for Brett too. It's just so good to interact with somebody who is bright and thoughtful and spends their whole life doing reams of homework on markets and just knows what they're talking about. And is a pretty good guitar player to boot, I have to tell you. I've seen Brett play. We hung out with him in the offices there in Florida. And the guy he's good at teaching himself difficult things. And as you heard, he's got a head for math and has applied it to markets very well under the tutelage of Steve Sjuggerud over many years. And that's what you come up with. A really bright guy, always learning, great insights on the market, and very reasonable, sensible view. It's a very reasonable, sensible view that he articulated about housing right now. And it's not lost on me. When I talk about the extreme sort of risks that I so often are kind of my bailiwick these days, I don't mean to suggest that they're the only outcome. In fact, believe I've emphasized that you should prepare for a variety of outcomes. That's why I always say prepare, don't predict. But what I'm getting to here is guys like Brett tell you what I think is probably more likely to happen based on current conditions, where I'm telling you about things that are more likely than you suspect, even though they're still highly unlikely. So you see, you know, I feel like you need to know about both of those things. That's why I have reasonable people like Brett on the show to discuss them. That was a lot of fun. All right, let's try to have some more fun in the mailbag. Let's do it right now. Look, I think you know by now, I'm always trying to tell you the really hard truths, even when, especially when, what I have to say is unpopular. Today, the hard truth is that your wealth is in danger. Everything you may have made in the bull market of the last decade could disappear very quickly. Some of it's probably gone already. This process has already started, and even if the financial markets somehow avoid a devastating crash from here, inflation is still eating 8% of your money every year. I've spent 20 years helping people prepare for extreme market shifts, just like the one we're going through right now in my role at Stansberry Research. I've recommended 24 triple-digit winners, and I called the collapse of Lehman Brothers with near-perfect timing. Well, today I'm issuing my biggest warning ever. If you want to preserve your retirement and your lifestyle in the coming years, you need to act. I recently went on camera to lay out a simple one-step plan for what to do. You can set yourself up in minutes and likely forget about inflation, rising prices, or the worst effects of a market crash for years to come. This plan does not involve options, shorting, crypto, or anything complicated, and it doesn't require perfect timing. The perfect time to act is right now, and you could see triple-digit upside in the coming years. To watch my full interview with the brilliant financial journalist and hard asset expert Daniela Cambone, simply go to www.crashprotection2022.com. Again, that's www.crashprotection2022.com to watch our full interview for free. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Send questions, comments, and politely worded criticisms to feedback@investorhour.com. I read as many emails as time allows, and I respond to as many as possible. Or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. A light mailbag this week. We did get a few crypto questions from our interview with Eric Wade, but I think I'm going to pass those along to him and either get some responses to read, or maybe I can, he's a busy guy, but maybe I can rope him into coming on the show for a few minutes to talk about them. But this week, very light. I only have one question, and it comes from longtime listener and frequent correspondent Lodevik H. And he says, Dan, actually he says, hi, Dan. Well, hi, Lodevik. He says, I was walking and I had an idea. The trade in Russia-issued government bonds is slowly starting up, but Russia can't repay. But it is said to pay off in other things. I think he means other commodities. He's getting to that in a minute. He continues, with Russia having a bankrupted rating, it would mean the price is somewhere between 5% and 30% of nominal value. Why not buy some government bonds and inform Russia you're okay with no US dollar payment? Gold is fine. When they repay you, you get 100% in gold. Normally, I'm against investing in government bonds. The Greek default shows investors are not created equal, so stay away. But this might be an interesting way to acquire gold. Just an interesting idea for consideration, Lodevik H. Lodevik, you know more about this than I do. If you're going to default, if you're a sovereign and you're going to default, and you're kind of in a position of some power, at least, as Russia is, with the amount of energy and other things that they supply to the world, do you want to be paying out your gold on your sovereign debt? I'm not sure that you do. I don't claim to have considered all the dynamics of that or even understand them very well. But it just seems to me like if you're in default and the bonds are trading between 5 and 30% anyway, like, why bother? You're there. We're there. They're there. They don't need, I don't think they need to do anything, but I could be wrong. You're right. It's an interesting idea to consider. And I think somebody who's probably more experienced thinking about these things in terms of like game theory, what are their options? What would they most likely be to do? Might think this through a little better than me. But I'm glad you brought it up. It's an interesting idea. And that's it for the mailbag this week. And that's it for another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_hour. Have a guest you want me to interview? Drop us a note at feedback@investorhour.com or call the listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.